For 40 years, the entire financial industry has been selling you a piece of playground equipment. They don't call it a toy, of course. They call it the 640 portfolio. They call it modern portfolio theory. They wrap it in complex mathematics and shiny brochures featuring retired couples walking on beaches. But if you strip away the marketing and look at the engineering, it is just a seesaw. The design is elegant in its simplicity. On one side, you have the risk asset. Let's call him the wild kid. This is the stock market. He is energetic, he is volatile, he produces growth, but he is prone to violent tantrums. On the other side, you have the safety asset, the calm kid. These are your bonds, government treasuries, fixed income. His job isn't to grow fast. His job is to be the counterweight. The sales pitch, the blueprint that every financial advisor has used since the 1980s, relies on a single principle of physics. They call it negative correlation. That is a fancy way of saying that these two kids move in opposite directions. When the wild kid crashes, the calm kid lifts him up. When the stock market collapses, investors flee to safety, buying bonds. This is the promise. The safety net. It means that even in a crash, you never hit the ground. I am the yield architect. I am not a financial advisor. I am a structural engineer. And in my world, we don't trust theories. We trust physics. And when I look at the 60-40 portfolio, I don't see a safety net. I see a structure that relies on a single critical point of failure that almost no one is checking. A seesaw is a lever, and every lever relies on a fulcrum, a pivot point. In this machine, that pivot point is held together by a single metal bolt. If that bolt holds, the kids balance. If that bolt shears, the game is over. In the global financial system, that bolt is interest rates. Specifically, the federal funds rate and the yield on the 10-year Treasury. This is the gravity that holds the entire system together. And for the last 40 years, essentially the entire career of almost every financial advisor working today, that bolt has been doing something very specific. Since 1981, interest rates have been in a structural downtrend. We went from 15% yields down to essentially zero. In engineering terms, this means the bolt was well greased. It was loose. It allowed the seesaw to move freely. When rates fall, bond prices rise. It is mathematical law. So for 4 decades, every time stocks got in trouble, central banks cut rates and bonds went up. The seesaw worked perfectly. It worked so well that people forgot it was a mechanic. They started treating it like a law of nature. Bonds, hedge stocks. They wrote it in textbooks. They built trillions of dollars of retirement plans on this foundation. They assumed the bolt would last forever. But metal fatigues, and economic cycles turn. Then came 2022, the year the physics broke. Inflation, which had been dormant for decades, suddenly woke up. The Federal Reserve, in a panic, didn't just tighten the bolt, they hammered it. They raised interest rates faster than at any time in recent history. When you raise rates into a debt-saturated system, you aren't just tapping the brakes. You are seizing the engine. You are freezing the pivot point. And here is the thing about a seesaw with a frozen pivot. It can no longer tilt. Watch closely. This is the structural failure. The wild kid, stocks, jumps down because the economy is slowing. But because rates are spiking, the calm kid, bonds, is also crashing. The math that dictates bond prices says that when rates go up, price must go down. Snap. The correlation flips. It goes from negative on balancing to positive, coupling. The seesaw didn't tilt, it collapsed. In 2022, the S&P 500 fell by 18%. That is painful but normal. But the safe part of your portfolio, long-term treasuries, they fell by over 30%. The safety net didn't just fail to catch you. It strapped an anchor to your ankle and dragged you down faster. This was the worst year for the 60-40 portfolio in a century. It wiped out trillions in wealth. But the money isn't the real loss. The real loss is the illusion. The blueprint is burned. Now, the experts will tell you it was a fluke, a one-off. They are telling you to get back on the seesaw. They say, rates have peaked, the balance is back. But look at the structure. Look at the debt. The US government is adding $1 trillion of debt every 100 days. Inflation is sticky. The era of 0% interest rates, the era of the greased bolt, is gone. We have entered a new regime. A regime of fiscal dominance and structural inflation. In this environment, stocks and bonds are not enemies. They are roommates. And when the fire starts, they both get burned. If you are within 5 to 10 years of retirement, you cannot afford to rely on a broken mechanic. You cannot afford to hope that the correlation returns. Hope is not an engineering principle. Hope is not a strategy. You need a new blueprint. If you want to understand how to rebuild your wealth with actual structural integrity, make sure you are subscribed to this channel. I am taking apart the entire financial system, piece by piece, to show you where the weak points are. So, what is the solution? If the seesaw is broken, what do we build instead? We stop trying to balance volatility. We stop trying to time the jumps. Instead, we build a foundation that generates its own stability. We move from capital gains investing to income-first engineering. The flaw of the seesaw is that it relies on price. You need the price of bonds to go up to save you. But what if you didn't care about the price? What if you focused on the yield? When you design for income, you are building a structure that pays you whether the market is up, down or sideways. You aren't hoping for a greater fool to buy your assets at a higher price. You are getting paid rent. You are getting paid dividends. You are getting paid interest. The seesaw is a fragile structure. It requires perfect conditions to work. The pyramid is a robust structure. It survives the storm. The 60-40 split was a great idea for the 1990s. But you aren't retiring in the 1990s. You are retiring in the 2020s. The bolt has rusted. The physics have changed. Don't let them put your life savings back on that broken toy. In the next video, I'm going to show you the specific materials we use to build that pyramid. The assets that don't rely on the Federal Reserve's mercy. But for today, just remember, check the bolt. I am the yield architect. Class dismissed.